$105,534. That is how much tax we avoided by utilizing buy, borrow, die. And here's the thing. The example I'm going to show you, it's based on a true client experience. But this isn't someone who is Bill Gates or Elon Musk. This is just a couple in their prime earning years with a really good nest egg, just looking to be a little bit more tax savvy with their wealth. So stick around and I'll break it down all for you. I promise you, you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need help with your own financial plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So buy, borrow, die is something that gets thrown around and portrayed as something that only billionaires use. But the reality is that more people can utilize the strategy than you probably realize. And what you are going to see today is going to be a prime example of that. So if you're not familiar with buy, borrow, die, we did an entire video on it. But in a nutshell, this is a strategy where you set up a line of credit using your stock portfolio as collateral. And with this line of credit, you'll borrow against your portfolio to raise the capital you need to remodel a house, make a down payment, buy a car, etc. Now, the whole reason why we're borrowing against the portfolio instead of selling some of your stocks to raise the cash you need is to avoid tax. If you have a stock portfolio with lots of unrealized capital gains, every time you sell and raise cash, you could be looking at a huge tax bill. So rather than deal with this potentially large tax bill, we'll simply borrow against the portfolio, pay interest, and eventually repay the loan with income down the road. If you are listening to this and are thinking you have heard something like this before, you probably have. A recent famous example of buy, borrow, die in action was Elon Musk collateralizing his stock portfolio, largely made up of Tesla, to finance the acquisition of Twitter. But you're not Elon Musk, and you don't necessarily have to be Elon Musk to use this type of strategy. You really just need, number one, a portfolio that can support the line of credit. Number two, income to ideally pay off whatever loan you decide to take out. And number three, there needs to be a tax benefit to justify using the strategy. If all three of these line up, this could be a strategy to consider and deploy. So let's go ahead and dive into our example. Again, this is very much based on a real client scenario, but we have obviously created fake names and have tweaked the numbers for confidentiality purposes. So this is Homer and Marge Sample. They have a joint adjusted gross income of $800,000, and they've done a pretty good job saving to this point. They each have about $250,000 in their 401ks. They have $50,000 in their emergency fund, and then they have a big old joint brokerage account with about $1.2 million in it. Now here's the deal. That account has some concentrated stock in it. You see, Marge worked at a company that gave her a ton of stock in compensation, and that stock ended up really appreciating in value and helped them be worth this amount. But here's the problem. They want to put a $400,000 down payment on a house, but they don't have cold hard cash lying around to do that. If they wanted to raise $400,000 from their joint brokerage account, they would incur, hypothetically, $300,000 in long-term capital gains. Now, most people think, well, long-term capital gains is 15%. So 15% of $300,000 is $45,000. That sucks, but it ain't so bad, right? Well, let's break down what the tax liability actually is. So the number on the left-hand side is their current federal tax liability. And the number on the right is their new federal tax liability after factoring in that $300,000 long-term capital gains hit. The actual number isn't $45,000. It's $71,400. And the reason for this is, given how high their income is, their capital gains rate is actually 20%, and they have to pay net investment income tax of 3.8%. Now, don't forget, we have to bake in whatever their state tax bill is as well. So in this case, because they live in California, they will have $33,244 in additional taxes associated with that capital gains hit. And the reason for this is California taxes long-term capital gains as ordinary income. Plus, they are subject to California's mental health services tax since their income is over $1 million. So if you are keeping score, we're looking at a tax bill of $105,534. That's an effective tax rate of about 35% on the $300,000 in long-term capital gains that they absorbed. So that's a lot higher than 15%. That's a huge tax hit. Now, given the fact that the $1.2 million that they have is all in stock and they only have $50,000 in their emergency fund, they're probably going to have to sell even more stock to raise cash needed to pay for that big tax, which compounds the problem. The alternative route that they could pursue is the buy, borrow, die strategy, or stated more formally, we're going to set up a line of credit using their stock portfolio as collateral. Now, I want to use some realistic numbers to bring this all to life. So this is an actual quote for how much their line of credit would cost them. These lines of credit are going to be heavily impacted by whatever the Fed funds rate is, since SOFR, or the secured overnight financing rate, is heavily correlated with it. So SOFR, as of the recording of this episode, was at 5.33%. Plus, the bank we are going to use to create this line charges 2.25% on top. So we're looking at a total rate of 7.58%. Now again, keep in mind this could potentially be cheaper since this is a variable rate, and if the feds end up cutting rates, maybe we get a better deal. And that figure of $720,000 to $780,000 is the estimated size of the line of credit that we could potentially establish based on their $1.2 million brokerage account. We're not going to borrow the entire line of credit. We're just going to borrow the $400,000 we need for this down payment. Now, obviously, this isn't a free lunch. We still need to pay that 7.58% worth of interest, which would be $30,320 over the next year. But we'll take that over paying $105,534 in taxes now. A big misconception with buy, borrow, die, or borrowing against a portfolio to avoid taxation is that the loan is kept outstanding in perpetuity. That's an absolute myth. I have executed this strategy for clients with $500,000, and I've executed it with clients with literally over $100 million in a brokerage account before. No one goes into this thing with the idea we're just going to keep the loan outstanding forever. The idea is we're going to have income flow in that can easily cover the loan over the next, call it 12 to 24 months. And that's exactly what we modeled out for these clients. Given their income over the next 12 months, the forms of equity that they're receiving, salary, bonuses, etc., we discovered that they could easily cover that $400,000 loan. So a couple of frequently asked questions that I get on this topic. The first one is, why don't you just keep the loan outstanding forever if we can avoid taxes? The reason why we don't keep it outstanding forever is, number one, it obviously costs money because we have to pay interest on it. Number two, a securities-backed line of credit is all based on the value of your stock portfolio. If your stock portfolio were to fall significantly in value, you could be forced to liquidate your holdings in that account to cover the outstanding loan. And that would create issues not only from a tax perspective, since you'd be forced to eat capital gains, but you are also forced to potentially sell at a really crappy time in markets. So it's critical that you understand what the loan to value is on that line of credit and what would trigger a potential maintenance call with that associated loan. The second common question that I get on this topic is, how does it impact your credit? So setting up these lines of credit can result in a hard credit pull depending on the bank or lender that you're utilizing. However, the outstanding loan balance generally doesn't get reported to credit bureaus. So in this example here, for these clients, we're assuming we already had the line set up ready to go. However, if we didn't have one set up, we would need to explore lenders or custodians who would create a line without creating a hard credit pull. Again, I cannot stress this enough. You can get burned real bad if you don't understand the maintenance requirements associated with your line of credit and don't have a plan for repayment. But if you know how to use this strategy the right way and responsibly, it is, in my opinion, one of the more savvy tax strategies out there. There's a reason why members of Congress have proposed taxing unrealized capital gains, because a lot of high net worth and high income individuals use this exact strategy to circumvent tax. So there you have it, guys. Hopefully you found this episode informative and fun. Be sure to hit that like and subscribe button so that you can keep getting content just like this. And of course, if you need help with your own tax and financial plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I'll see you next time.